I would say that whether the budget will be able to stimulate growth is a big question mark, because if you look at the overall spending, actual spending that they did last year against a 8.5% or 8% target, they actually achieved only 6%. I think there is a sort of constraint that is happening because of the tax collection, which has actually been slowing. I think we are barking up the wrong tree if we are looking at growth upliftment when the structural where the structural growth is actually slowing. RBI has kept the repo rate unchanged at 6.5%.
Thank you, Dhananjay. It's good to have you again in a space of about a week. Many viewers liked your insights in the run-up to the budget. Now we go into the RBI's monetary policy review.
Sure.
To all of you viewers, Dhananjay is the co-head of equities and head of research at institutional brokerage Systematics. So Dhananjay, will MPC cut the repo rate tomorrow? And should it cut the repo rate tomorrow?
So I think generally there is an expectation. I would say 80 to 90% of people believe that there should be a rate cut. I think after a gap of 2 years, people expect a 25 basis point rate easing. Our view is that RBI should hold on to the current levels of 6.5% for various reasons that we can elaborate. But we think there are multiple reasons why RBI should be holding on to rates, and I don't think it has the bandwidth or there are limitations to which this can actually be ineffective. And we have mentioned earlier there are limitations and limitations to the utility of rate easing at this point of time.
Why do you think so?
So several reasons. I would say if you look at the primary objectives of the RBI, which is basically ensuring growth and price stability, I think price stability has a major role to play. And if you look at the current level of inflation, it is well above the 4% target that RBI has, currently hovering around 5.4, 5.2% kind of range. And that is above the target. And if you look at I would say the inflation numbers over the last 10 years or so. It's 84% of the time it's been above 4%. So most of the time it is above 4%. I would say even in recent years, it has averaged about 5%, and that is still above the 4% range. So we have not met the inflation target that RBI has been talking about, especially in the context where the demand situation has been fairly weak. And if you look at the average consumption growth has been just about 4%. So with that, if you have a sort of a 5% average inflation, that's still having an impact on the cost of living and the livelihood situation of the people. So I don't think RBI has actually met its target in a substantive way as of now.
If you look at the other side of the argument, what do you fear would happen if the RBI doesn't cut interest rates tomorrow? What is the other side saying?
So I think I think its government also has been saying so that there is a need for RBI to cut rates. It thinks that the RBI is overtly restrictive, and it's actually preventing private capex to happen. So that is one aspect of what people are saying. Other set of people are largely market analysts, and the market participants are saying that since the GDP growth has actually come down to 5.4%, much more than what the officials were expecting or markets were expecting, the slackness of economic growth essentially deserves sort of rate easing, in the context that their expected potential growth is about 7%. So you're well below the 7% levels, and hence the RBI should actually relent and start cutting rates at this juncture. So I think that's the general view that people have in the market. Whereas I think it's far more complicated in the way we analyze things. So I think there is a sort of a difference in opinion. I would say if you look at the fundamentals that we are looking at and the way markets are looking at and how the consensus is viewing the monetary policy.
Do you buy the logic offered by the finance ministry, especially Finance Secretary Tugin Kanta Pandey, who said that the budget has done its bit to create space for the Reserve Bank of India to cut interest rates by not resorting to very high revenue expenditure? Do you think the tax ops would do the trick, and then have they created space for the RBI to cut interest rates?
So I think why the government has been very insistent upon rate easing is largely because almost like a third of the total revenue expenditure is going into interest payment, and the debt burden of the government has actually been skyrocketing. It's currently about, I think the revised number is about 190 trillion rupees. So 100 no, 190 lakh crores, and that's an increase of almost like about 100 odd uh, lakh crores over the last 5 years. So the government wants the interest cost to come down, and that is why it wants RBI to sort of cut rates. It wants the RBI to manage the yield curve and intervene in the yield in the GSEC market to ensure that the cost of fund is lesser. That gives space for the government to actually spend on other items such as revenue expenditure and capex, and also manage the fiscal deficit targets. I think that's where the government is coming from. I would say that the other argument that officials have is that if you cut rates, there will be it will spur private capex. That I think is not really substantiated given the history of the last 10 years or so. I would say what whether the government has actually provided space or not by following a fiscal consolidation path. I think it has actually, but nevertheless, the burden of fiscal deficit is still very large, in despite the fact that the target has been scaled down and there is a consolidation that's been there. At I mean, they're targeting 4.4% of GDP as fiscal deficit, still above the FRBM target of 3%. So I think the while the government has actually been doing a fiscal consolidation path, I would say what the RBI is focused should be focused more on the price stability and essentially assessing what is the potential growth. I think there is a considerable amount of assessment that needs to be made, versus what is seen as potential growth at 7%, and what actually might be the potential growth could be much lower. And hence, if you sort of do rate easing at this point of time, it is quite possible that the inflation might actually go up. And as I said, in the recent times, the inflation average has recent years, inflation average at about 5% higher than what RBI's target is. So I think those are the consideration RBI should be having while deciding on the rates.
If you've noticed the recent liquidity measures taken by the RBI, do you think that these measures imply the possibility of a rate cut, or do they eliminate the pressing need for a rate cut, or do they facilitate the transmission of a cut if it is in the offing, and to facilitate that these measures were taken? How do you read the liquidity measures?
So I think if you look at the liquidity situation in the banking system, RBI had moved towards a sort of a normalization when they did the rate hikes, etc. Till 2 years back. I would say I think the last hike was in February 2023 at 6.5%. Since then, actually, they have actually reduced the excess liquidity that provided post COVID. And if you look at the average liquidity as percentage of the NDTL, net time and demand deposits of banks, it has been hovering around zero, or it's been kind of marginally mostly been in surplus, but closer to the 0% mark. By and large, hence I would say that the RBI has not really tightened liquidity as much from a long-term standpoint. I would say this is true also in the last 8 years. Recently, the tightening has happened largely in the context that the RBI has intervened in the foreign currency market to stabilize the rupee. As a result, the shortage had happened. The deficit had gone up to almost like 3.5 lakh crores. And in response, RBI has announced CRR cut of 50 basis point. They have announced OMO purchases of GSEC to the tune of 600 billion rupees. These are measures to actually replace the liquidity deficit they were actually funding through repo interventions. So I think it is more of a replacement of liquidity deficit with an enduring instrument, both by way of the CRR cut and the OMO purchases. I think the rate decisions are more to do with the macroeconomic variables and the targets that RBI sort of looks at rather than liquidity management. I think these are two different areas of consideration for the RBI.
So you don't read much into the liquidity measures in the context of what the RBI could do tomorrow. Is that
Yeah, I
correct?
don't think I'm not extrapolating what RBI did through by way of liquidity inducement by way of CRR cut or the OMO purchases. So I think that's more on the liquidity management side. You still have a scenario where the rupee can depreciate much more, and one has to remember that the spread between the US and India 10-year US Treasury yields actually very low at 200 basis point, almost at an all-time low. So I think those are consideration on the FX side as well. Yeah.
There is one view which is coming across is that there is a possibility if the RBI is reluctant to cut interest rates tomorrow, it could might as well again announce another 50 basis point cut in CRR. Again, from a easing and a growth as an easing and a growth supportive measure. Do you buy that logic?
So I think, see, my fundamental view is that the liquidity deficit is largely occurring because of the currency intervention that RBI has been doing, and because of which, as you run down the forex reserve, you suck out liquidity because you sell a dollar against rupee resources, so that tightens the liquidity. I think we have mentioned earlier that. RBI should actually be less interventionist in the currency market. So I would say as you allow the currency to depreciate, your need to intervene will be lesser, and the tightening in the liquidity as a result of that will be lesser. I would say RBI will need to use some liquidity inducement measure to ensure that there is a calibrated depreciation that happens to a fair value, which we think is around 90 to 92 levels. So I think CRR cut and all can happen, but I don't think that as a monetary policy indicator. It's more like a liquidity indicator.
Okay. Circling back to growth, do you think the growth requires a policy response? And did you think that the budget did enough? And do you think that the response now has to come from the RBI, if not tomorrow, but anytime soon?
So I think there's a contradiction here. So I think on one side we are saying that the fiscal policies has been on a conservative side. We are looking at compliance towards a glide path towards a fiscal consolidation, which is essentially restrictive with respect to the overall demand side because it has a negative multiplier if the government is actually restraining primary deficit and the fiscal deficit. On the one, that's one side of it, and then we are also saying that the budget is actually pro growth from the announcement standpoint, largely to do with the tax cut that they have done with respect to the income taxes on individual. I would say that whether the budget will be able to stimulate growth is a big question mark because if you look at the overall spending, actual spending that they did last year against a 8.5% or 8% target, they actually achieved only 6%. I think there is a sort of constraint that is happening because of the tax collection, which has actually been slowing in the recent months. And I would say if you look at last 3 4 years, this whole fiscal consolidation has meant that the nominal expansion in the budget has been lesser than the nominal GDP growth, and the tax collection has been in the region of roughly about 10 to 11%, higher than the nominal GDP growth and much higher than the expenditure growth. So I think per se the budget construct has been a drag on the overall demand side, and that's what the fiscal consolidation means. If you consider the 1 lakh crores worth of tax foregone because of the income tax easing that the government has announced, that is just about 0.5% of the total household consumption. That's personal final consumption expenditure, which is roughly about 200 lakh crores on an annual basis. And if you look at as percentage of total GDP, it would be about 0.35%. So I think there is much too much being read out of the tax benefit that the government has given. It's possible that some of it will actually seep out or leak out to the rest of the world by way of higher imports, because a lot of middle class spending has got import concentration. So those are the things. So I would say that whether the RBI, whether the budget has done enough to resurrect growth and all, I think there's a big question mark out there, because they have been actually restraining spending on a lot of the development expenditure, etc., which is impacting 90-95% of the population. So where the income growth is very low, and the income tax relaxation doesn't impact at all. So I would say that the budget hasn't done much with respect to growth impetus. As far as the RBI is concerned, we have to really, as I said earlier, we have to know what the potential growth is, because you can't have general view is that the 7% is the potential growth, and you have 5.4% as actual growth. Your inflation should be much lesser. It should be roughly about 1 or 2%. Which is not the case. It is averaging about above 5%. So I would say that in that context, the potential growth is actually much lower than the 7% that people are assuming, and even the current levels of 5.4%. Otherwise, you should be having low inflation, you should be having current account surplus, which is not the case. When the 4% inflation target was set, a lot of it was actually based on the Urjit Patel Committee report, which basically contextualized the 4% inflation to the 2003 to 2006 averages, where you had 4% inflation with a current account, which was on average on a balanced side, which is not the case. So you have above average inflation, above 4% inflation, you have a current account deficit. So I think the notion of potential GDP growth needs to be assessed, and my guess is that it is significantly lower than the 7% level that generally people expect.
So coming to growth, continuing with growth,
Yes.
who is holding the can insofar as reviving growth is concerned? The fiscal policy says that it is the monetary policy's responsibility, and then one doesn't know tomorrow what is the position the RBI governor is going to take. So who holds the can actually from a policy standpoint?
As I said, a lot of this, debate essentially has an assumption that the potential growth is 7%. Now, if the structural growth has actually come down, then I would say that holding RBI responsible for that will be absolutely imprudent, because RBI has a monetary policy instrument which is supposed to be counter-cyclical. It doesn't really respond. The structural growth will not respond to monetary policy actions at all. I would say that hence this whole blame game, so to say, that's been happening is misplaced. Essentially, the what you require is a structural policy response, which is more in the domain of the government policies, and to some extent fiscal policy, but largely it requires a lot of structural policies relating to employment, relating to industrialization, manufacturing, and also I would say this whole the demographic changes that are happening. I would say some examples that I want to lay out here is that the government study on the migration itself tells that there is increasing level of ruralization. As the migration falls, more and more people are relying on agriculture and rural activities, and that implies that the potential productive or the productivity on average has actually fallen. So that actually reduces the potential growth. So if you need to have a upliftment out there, you need to reverse that trend. You need to use the you need to use the unemployed, disguised unemployed people, and bring them into the productive in the productive side of the whole economy. and I think RBI has very little role to play. I would say even the fiscal counter-cyclical fiscal stance would also have a very little role. So I think it requires a fairly different. It is in a very different domain. I would say it requires a well-oriented or concerted, I would say, policies at the state level, at the central government level, for you to really uplift the growth. So I think we are barking up the wrong tree if we are looking at growth upliftment when the structural where the structural growth is actually slowing. And I would say counter-cyclical instruments and measures may not be very fruitful. It can give you growth for a short period of time, but it will fizzle out very quickly.
If you stick to the narrow of the budget and the commentary post budget and what is expected from the RBI, would it be fair to say that the fiscal policy is counter cyclical and the monetary policy is expected to be pro cyclical at this point of time?
I think I've answered this. The thing is that RBI, the fiscal policy is actually restraining. Actually, you're looking at containment in fiscal deficit. You are consistently following budget expansion much lesser than the GDP. So it has been a drag, irrespective of which irrespective of the fact that this budget had announced a sort of income tax cut. Overall, if you look at the overall math, there is huge amount of optimism that they have actually priced into the tax revenue collection, which is targeted at 11%. I would say with a tax cut, etc. I would say there can be a slippage out there, and eventually the spending growth would be much lesser than 7.4% that they have budgeted, which is lesser than the nominal GDP, and hence I would say the fiscal policy continues to remain pro-cyclically tight in the context of the slowdown in the overall demand. So I think it's not really helping. And if you look at the RBI, RBI has kept the repo rate unchanged at 6.5%. But if you look at the average real rate, if you subtract the CPI from the repo rate, the average is about 1.5% if you look at the last 2 years. And that's not very high. If you go back into history when the 4% inflation was seen as an equilibrium, and the current account balance was deficit was in balance, when the inflation target was set, that time the real rate averaged about 2%. So I would say if you sort of compare it against the ideal period on which the 4% inflation target was fixed, there the real rate was about 2%. We are actually lower at 1.5%. So and as I said, you have above inflation above the 4% target, and you have current account deficit. So I don't think RBI's policy has been restrictive from that standpoint if you look at their mandate. So I don't think, as I said, to summarize all this, RBI's, easing or accommodation may not really help. I think they are very much within their mandate to follow the inflation targeting independently.
Dhananjay, what are your estimates for FY26 GDP growth and also average inflation?
So I think, if you look at it, what I basically look at is the household income rather than the GDP growth. So GDP growth, if you look at the budget estimate, it does look like it is somewhere around 6.4% in real terms. If you look at the nominal growth projection, about 10.1%, so you back calculate it's about 6.4%. I think if you look at the household consumption expenditure, which is 60% of the GDP, and you add up the savings, which gets you the income, that's been growing in the region of 3.5-4%. So I think that's 80% of your total GDP, and I think that's where the core growth is. So I would say that there is a difference between what the headline GDP growth is projected at 6.4%, whereas the overall consumption, which basically decides whether the economy is growing, whether there is productive employment generation, whether there is productive wages that are happening, whether and on that you will have on that the private capex is dependent on. I would say that core growth is somewhere around. I would say around 4%. So I would say we looked at multiple ways of arriving at the structural growth does look to be at least 200 basis point versus lesser than the headline GDP growth. And I would say that on inflation, it depends on what RBI does. I would say that it could be averaging closer to 5.25% over the next 12 months or so. So that's how I look at the overall context.
So one final question: do you think RBI will cut tomorrow, or will it hold? The logic is what you've explained, but what do you think is likely to happen tomorrow?
So I do desire, my expectation is that they should not be cutting rates, but I would say the pressures are pretty much pretty high on the RBI. I think it's been fairly consistent over the last 6 months. The government wants the RBI to cut rates. We'll need to see whether they follow the fundamentals that I have explained, or they budge and they sort of cut rates after holding it unchanged for the last 2 years.
Dhananjay Sinha, thank you very much.